Oil futures just dipped to $103 a barrel, and if you searched for that number expecting good news at the pump, you are in the wrong place for comfort but the right place for the truth. The dip is not real. It is a paper move built on a 3-day supply fix layered over a problem that will take months, maybe years, to resolve, and the reason it will take that long has nothing to do with missiles or warships. It has to do with a piece of paper from an insurance company, the specific question this video answers. Why does that piece of paper matter more for your gas prices than the war itself? By the end of this video you will understand exactly why the $103 futures price is a trap, why 20 million barrels per day are effectively frozen not by guns but by contracts, and why the moment paper oil fails to deliver, paper silver and paper gold are next in line. This channel tracks where the physical commodity is actually moving, and why that always diverges from the headline price before the crowd figures it out. While mainstream media was covering the strategic petroleum reserve release and calling it a supply solution, this channel was watching the insurance designation that happened 4 days earlier. Those two stories are not the same story, and only one of them tells you what gas costs in September. If you are watching because you want to understand what is driving fuel prices beyond the ticker, drop the word blackout in the comments, then hit subscribe and drop a like. The algorithm needs a signal the same way the market does. Give it one. Here is the number that anchors everything in this video: 20 million barrels per day. That is the daily flow volume through the Persian Gulf and the Gulf of Oman that is now effectively frozen. Not because the strait is physically closed, because on March 5, 2026, the international group of P&I clubs designated the entire Persian Gulf and Gulf of Oman as uninsurable zones. There is one specific consequence of that designation I am going to come back to after we walk through the delivery mechanics, because without that context it reads like a legal footnote. It is not a footnote. P&I stands for protection and indemnity. It is the insurance that covers a ship operator for third-party liability, cargo damage, crew injury, environmental spills. Without it, no major international port will allow a vessel to dock. The moment that coverage is pulled from a region, any tanker sailing from that region becomes a vessel that cannot legally unload its cargo anywhere that matters. That is the insurance blackout, not a missile, not a blockade, a clause in a marine insurance contract that makes 20 million barrels per day legally untouchable. Most people watching the news right now are seeing the headline price and the SPAR release and thinking this is a supply problem with a supply solution. It is not a supply problem. It is a legal problem, and legal problems do not resolve in 3 days. What comes next is where the energy crisis connects to something most oil price viewers have never had to think about before: the futures delivery question. A futures contract is a legal promise to buy or sell a specific amount of a commodity at a specific price on a specific future date. Every day, millions of those contracts trade on exchanges in New York and Chicago. Almost none of them are intended for physical delivery. The traders selling them are betting on price direction, not moving barrels. Now the problem: some of those contracts are held by entities that actually need physical oil: refiners, distributors, industrial buyers. When delivery day comes, the seller of that paper contract is supposed to arrange for actual barrels to move to an actual hub, most often Cushing, Oklahoma. The insurance blackout means the barrels cannot legally move from origin to hub. The seller of the paper contract cannot fulfill the delivery. That is a forced default, and forced defaults in paper oil markets do something specific. They push large institutional money toward the one market where physical delivery is still considered reliable. That market is not New York, and that is the number I told you I would come back to. Right now, physical oil buyers who cannot wait for the insurance situation to resolve are paying shadow market prices, often $20 or more above the futures price, just to find a tanker that carries grandfathered coverage or is willing to sail without transponders. The futures price dropped, the physical price exploded. Those two things cannot stay disconnected indefinitely. Here is what that gap actually means for a person filling a tank right now. The price at the pump does not track the futures price. It tracks the physical price. The futures dip to $103 was a paper event. The refinery still paid the physical premium to get the crude. That cost is coming. Let me show you the delay case honestly, because that matters more than cheerleading. The G7 coordinated release of 60 million barrels from strategic petroleum reserves was real. That is roughly 3 days of the volume lost. If the insurance designation is reversed quickly, say within 4 to 6 weeks, under diplomatic pressure, the dislocation could partially correct, some alternative routing through longer shipping lanes around the Cape of Good Hope exists, though transit times increase from roughly 2 weeks to 6, which adds cost and reduces effective supply without eliminating it entirely. Those are the real factors that could slow this, worth knowing. Here is the counterpressure. Insurance blackouts are not reversed by diplomatic statements. They are reversed by actuarial risk reassessments, which require sustained absence of threat events, not press releases. The international group of P&I clubs has never reversed a major zone designation in under 90 days. The physical premium for shadow market tankers is already in the market. Refiners are already paying it. The Cape routing adds roughly $40 per barrel in additional freight cost on top of the shadow premium. Paper futures can be pushed anywhere. The physical cost of moving crude cannot. Now verify this yourself. Look up the international group of P&I clubs March 5th designation. Check the NYMEX registered crude inventories at Cushing against current open interest. Look at Brent physical differentials reported by Reuters and the Financial Times over the past 2 weeks. The data is public. The people who check it do not need anyone to explain the gap to them after the fact. For the viewer who is brand new to energy markets, the number 2 track is the physical premium over the futures price. When that gap is above $15, the futures price is no longer telling you what oil actually costs. Watch that gap for the viewer who already holds physical precious metals. The insurance blackout thesis matters to your position because it is the first large-scale, documented case of paper contracts failing to deliver at scale in a commodity most people consider fully liquid. Watch how institutional money repositions out of paper oil over the next 30 days. For the viewer considering any position, do not make any decision until the insurance status is officially reviewed. That review date is the actual catalyst, not the futures price on any given day. For the viewer who trades futures, the Cushing inventory draw against current open interest for the front month contract is the most relevant number before the next delivery window. Check the NYMEX warehouse report, not the headline price. This is education, not financial advice. Use your own brain, do your own research, always. Scenario 1, bullish. The insurance designation holds through the second quarter of 2026. Physical premiums remain elevated. Futures prices track higher toward $130 to $150 as strategic reserves are exhausted and Cape routing costs compound. Probability, 55%. Scenario 2, neutral. Partial diplomatic resolution reduces the uninsurable zone by late April. Alternative routing absorbs the volume reduction at elevated but stabilizing cost. Futures trade between $105 and $120 through mid-year. Probability, 30%. Scenario 3, bearish, full insurance. Reinstatement within 6 weeks driven by a ceasefire agreement. Futures retrace toward $92 to $95. Physical premium collapses. Probability, 15%. If you want to understand why the exact same gap between paper price and physical price exists right now in silver and gold, and why the Shanghai market is pricing physical metal at a premium that Western futures have not caught up to yet, that breakdown is on this channel. That is where this story gets serious, and it connects directly to everything you just watched. Everything covered here is for educational purposes only. This is not financial advice. Use your own brain. Do your own research, always.